Do you want to turn $1,000 into $100,000? That's what I did in just under 5 years. In this video, I'll show you a low-risk investment system, Focus, which will get you from nothing to thriving investments. Starting with F, which will help you avoid costly mistakes and prepare for emergencies. Just like a garden needs rich, healthy soil, before planting, your financial journey needs the right groundwork to see sustainable growth. For most people, this means tackling high-interest credit card debt first. After all, even a great investment earning 12% or more cannot outpace the interest accumulating on a credit card balance. Your best initial investment is reducing and eliminating high-interest debts. I recommend the snowball method, starting by paying off the smallest balance to build momentum. Tackling the largest debt first might cause frustration and lead to quitting. Next, research and find a bank offering high-interest savings accounts. This account will be your safety net for life's unexpected events, like an accident or a job loss, not for luxuries like vacations. Once set up, this emergency fund will be untouchable as your safety net. The amount should cover your expenses for approximately 3 to 6 months. Next, it's a good idea to look for quick and easy wins. Here are 3 methods to get you going. Method 1. Avoid surcharges. I noticed many places in Australia added a 1.5% surcharge for using a credit card. So, I switched to using cash for everyday purchases, allowing me to save this 1.5%. It might seem small, but over time, that savings really adds up. A typical high-interest savings account is only 3 or 4%. Method 2. Maximizing your pre-tax money into your retirement accounts, such as 401k in the US, superannuation in Australia, or ISA in the UK. Often, the amount going into these accounts isn't the maximum, and you're leaving money on the table. Method 3. If you're in the US, check if your company offers 401k match. This is when your company will match the contribution you make up to a given threshold. This is free money. With a clear, fertile foundation and $1,000 saved, you're ready to plant your seeds of your financial future. That is why F stands for foundation, as that's the first step. Now we move to O, which will help you understand why stock prices move like they do and give you confidence in your investing decisions. To explain, imagine a vegetable seedling. Its growth is influenced by access to water, sunlight, and nutrients, just like a company's stock is influenced by its ability to generate revenue and people's reactions to the various news. What makes share prices go up or down? The answer lies in demand and supply. Just like when a popular band comes to town and tickets go on sale. If a band is popular and more people want tickets than there are actual tickets, the price will be high. On the other hand, if that band isn't very popular and there are less people wanting tickets, leaving a surplus, the price will be low. The stock market works the same way. Only the factors influencing demand and supply can vary significantly. These factors fall into 2 categories, long-term and short-term. Long-term factors. Think of long-term factors like plant roots. These are grounded in the company's overall health. Things like revenue, free cash flow, and debt. Together, these elements determine what the company is truly worth over time. This is called intrinsic value. People who focus on these factors are practicing what's called fundamental analysis. Short-term factors. Think of short-term factors like the weather each day. One day is warm and sunny, the next day it might be cold and rainy. Good news will often trigger prices to go up, and bad news will often trigger share prices to go down. Here, emotions and sentiment like fear and greed play a big role. For instance, if there's a rumor a company is launching a new groundbreaking product, demand might spike, sending the prices up, even if the rumor isn't fully true. On the flip side, bad press or market panic can send the prices plummeting. This price trend doesn't always reflect the true value of the company. Instead, it shows the emotional reactions. People who analyze these trends are practicing what's called technical analysis. Well, weather, like news, can change quickly. Strong roots, like companies' health, ensure a lasting growth. Understanding these dynamics is key to making smarter, more confident investment decisions. When you know what's behind the price changes, you can better evaluate whether a stock is a good buy or if the price is influenced by other factors. Start small. Pick 1 or 2 companies you're interested in and observe their stock prices for a month. Watch how the price reacts to news or financial updates. Over time, this builds confidence and knowledge. Key nutrients for your garden of wealth. This is why the second step, O, stands for obtain knowledge. Now, moving to C. That'll get your 1K working for you like a boss. Think of this step as planting seeds. Vegetables don't grow unless you plant them, water them, and keep an eye out for pests. Similarly, your 1K won't grow unless you put it to work. First, choose a broker. Think of that like choosing a gym. You want one that's easy to use, affordable, and has all the equipment you need to be successful. Things to look for: low fees, so your gains aren't eaten up by costs, user-friendly platforms, because no one wants a confusing setup, good reviews to ensure reliability and trustworthiness. For example, I personally use Interactive Brokers. They offer competitive pricing and a wide range of investment options. If you're new, take some time to compare a few brokers and pick the one that feels right for you. But don't get stuck picking a broker. You can always change later. Next, before jumping into real investments, test the waters with virtual funds. Most brokers, including Interactive Brokers, offer a feature called paper trading. Think of it as a game of Monopoly. Practice making moves without risking real money. You can simulate buying and selling stocks, watch how your portfolio performs, and get a feel for how the market reacts to news and events. Spend a couple of weeks here, buying fake stocks, tracking fake portfolios, and celebrating fake wins. It's fun, it's educational, and it's a low-pressure way to build your confidence. Next comes the fun part, choosing which stocks to include in your portfolio. With shares, a great place to start is selecting a stock such as a ticker SPY that follows the S&P 500 index. This index tracks the performance of 500 largest companies in the United States. Why is it a big deal? Imagine your favorite radio station playing the Billboard Hot 100, where only the best performing 100 songs get to stay. If a song underperforms, it gets kicked out and replaced with a stronger one. This keeps the S&P 500 index on an upward path over the long term. Here's a confidence boost. For the past 40 years, the S&P 500 has grown 77.5% of the time, even surviving big crashes and bouncing back stronger. It's like the Rocky Balboa of investments, always getting back up. Next, it's time to put your plan into motion. Deposit $1,000 into the broker account you set up earlier. Now is the big moment, and plant your seeds. Find the ticker you want to invest in, such as the SPY, and within a few clicks, you'll officially own a piece of that company. How cool is that? You're not just a spectator, you're now a shareholder. By taking these steps to execute, you've gone from learning to doing, and you're officially an investor. It's not about perfection, it's about progress. That's why the third step, C, stands for commit to action. Execute your plan consistently, and over time, you'll start to see results of your commitment. Now, moving to the U, that will have you investing worry-free. Let me be honest. Staying disciplined is one of the hardest parts of investing. It's easy to feel like a genius when the market's booming. But when prices drop, the panic sets in, and many investors make costly mistakes. This is where consistency becomes your superpower, helping you navigate the highs and lows with confidence and staying calm. Consistency in investing is like a garden. You don't plant seeds one day, dump a single bucket of water, and expect vegetables the next day. You water it regularly, even when the weather's not doing very well, trusting that your steady care will lead to growth. Investing works the same way. Here are 2 simple strategies that can help new investors build consistency without getting overwhelmed. Strategy 1, which is one of the most effective ways. Invest a fixed amount of money at regular intervals, regardless of what the market's doing. Example, buy $100 worth of stock every month. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this strategy averages out the cost per share, reducing the impact to the market volatility, and this is called dollar cost averaging. Why is dollar cost averaging so powerful? Because it takes emotions out of the equation. You don't have to stress about timing the market perfectly or making big decisions when prices swing wildly. Instead, you're building a steady habit of investing that keeps you focused on the long term. Strategy 2, which is turning on autopilot by automating it. Automation is like setting a sprinkler for your garden. It ensures steady growth without constant effort. Here's how. Configure automatic transfers from your bank account into your investment broker every payday. Configure auto invest in the stock ticker of your choice, such as SPY. This ensures that your investments happen regularly without requiring constant effort or decision making. By developing consistency, you're creating a habit that pays off exponentially over time. It's not about chasing perfection. It's about building the discipline. Consistent investing will help you weather the storms, enjoy the sunny days, and ensure your financial gardens flourish for years to come. Remember, slow and steady wins the race. Just like vegetables won't grow overnight, your investments will take time. But with constant care, they'll grow stronger and taller than you ever imagined. This is why the 4th step, U, stands for unwavering actions. Now, moving to S, that will help you see your portfolio grow to 100K and more. Investing isn't about starting strong. It's about staying consistent. even when the road gets bumpy. Let's face it, the markets will have their ups and downs, sometimes even extreme ones. It's tempting to panic sell when things go south, or chase the next big thing when the market's booming. But here's the truth. Investors that come out on top are the ones who stay the course. Think of your investment journey as like a long-distance race. You don't sprint at the start only to collapse halfway through. Instead, you pace yourself. You trust your training, or in this case, your investment strategy, and you push through the challenges. That's exactly what staying the course is all about. Having faith in your plan, even when things feel uncertain. Focus on your why. What's your reason for investing? Maybe it's to retire early, travel the world, provide for your family. Whatever your goal, keep it front and center. This helps you keep motivated. Write it down and revisit when the market wobbles. It's your reminder of why you started in the first place. Tune out the noise and the financial media because they love drama. Headlines about market crashes, miracle stocks can make you question your strategy. But remember, those stories are designed to grab attention, not guide your decisions. The best investors know to tune out the noise and stick to their plan. Your portfolio will thank you for it. Market downturns can feel like a storm, but storms pass. If your portfolio drops, don't panic and sell. Instead, revisit your written investing plan. Does your strategy align with your long-term goals? If so, stay the course. And if you're tempted to sell out of fear, remind yourself, you don't lose until you sell. Leverage the power of time. Here's the magic of long-term investing. Time is on your side. Over decades, the market has always trended upwards, even after recessions and crashes. By staying invested, you give your money the best chance to grow through the power of compounding. Your long-term harvest depends on steady, thoughtful care. It's okay to keep an eye on your portfolio, but don't let daily market movements dictate your actions. Schedule periodic check-ins, quarterly or yearly, to review your progress and to rebalance if necessary. Beyond that, let your investments do their thing without constant interference. This is why the fifth step is S, stands for stay the course. By staying the course, you harness the real power of investing. Constant effort over time. Stick with your plan, stay patient, and trust the process. It's not about chasing perfection. It's about building lasting wealth. Want to know the secret weapon successful investors use to grow their wealth consistently, even during market ups and downs? It's all about index funds. Watch this next video to learn how they work and which ones I've chosen to build a 100K portfolio.